Why Meta lost $230 billion, the biggest company loss in history. Terribly shocking content ahead. The market just experienced the biggest company loss in history to date, and this happened to none other than Meta, which is popularly known by its former name, Facebook. But why did it happen? And what is the future of Facebook after this? Well, today we are going to discuss why Meta lost $230 billion all of a sudden, which is considered as the biggest company loss in history, and all the questions related to this. Hello ladies and gentlemen, welcome back to AI Future Live. If you'd like to see more stock, business, and financial videos like this on the channel, like it and leave a comment with any topics you'd want us to cover in the future. So without any further delay, let's get straight into the subject. Facebook, Meta, and Mark Zuckerberg have been in the headlines a lot recently, and not all of them were good news. While the organization may get attention with fancy metaverse, tech demos, they usually make the headlines for something contentious, such as the influence of their programs, particularly Instagram, or the working conditions of their moderators. Despite the negative publicity, the corporation has continued to do exceptionally well financially. That was true until last week. So let's go through what happened and why the matter is in such a precarious position. So if you have any money in the stock market right now, you've probably seen that the stock market isn't doing so well in January. The S&P 500 index declined 11% from a high of $4,800 in January 1 to a low of $4,300 on January 27th. The worst month since the epidemic began, and the lowest since January 2009. The Nasdaq has done even worse, plunging 16% in the same period, affecting virtually every industry except oil and gas business, which have seen record profits owing to soaring energy prices. Unsurprisingly, the present downturn has harmed large tech companies the most. For instance, Netflix's stock dropped 40% in that time, following a drop in member numbers and losses of $159 million on $30 billion in sales the year before. This is what frightened the investors. Twitter has also dropped 50% in the previous 6 months, owing in part to Jack Dorsey's resignation, while PayPal has dropped roughly 60% in the same period. Facebook, or as its new name indicates, Meta, was one significant exception to this trend. Meta didn't have an especially poor January stock. It kept its value, which was a relatively respectable performance, at least in relative terms. Unfortunately for Mark Zuckerberg, Meta stock plummeted by 26% on Wednesday and Thursday of the first week of February, taking $240 billion off its market capitalization. This was the greatest one-day value fall in US business history in nominal terms. Zuckerberg, who owns 12.8% of the corporation, saw his wealth plummet by $29 billion. Aside from pitying the billionaires, what happened to Meta? However, there are three main explanations. The most apparent reason was Meta's end-of-year 2021 financial reports, which were announced on Wednesday. But there are two additional reasons why Facebook was likely overpriced to begin with. Investors' fears were at an all-time high, attributable to the broader market downturn. But first, let's look at the probable cause, Meta's end-of-year financial report. The Securities and Exchange Commission, SEC, which regulates the stock market, mandates corporations to publish 3 quarterly reports and 1 annual report. These earnings reports are frequently assessed based on whether or not they meet expectations. Analysts at certain banks will establish objectives for what they expect to see in the earnings report ahead of the time. And if corporations fail to meet those goals, the stock will often lose value. For many large corporations, the start of a new year signals the start of a reporting season. So, Meta released this on Wednesday, and it was a bit of a fiasco. 3 pieces of negative news were included in the earnings report. To begin with, they simply failed to meet expectations. The company's revenue for the first quarter of 2022 was projected to be between $27 and $29 billion, which fell short of expert estimates. They had projected revenue of more than $30 billion. Furthermore, Meta's profits per share were lower than anticipated. And while all this appeared to be terrible, it was made worse by the fact that most of Facebook's competitors, such as Apple and Microsoft, had just released remarkably strong earnings reports that exceeded their expectations. Secondly, Meta stated that Facebook had lost daily active users for the first time in its history, dropping from 1.93 billion in the first quarter of 2021 to 1.92 billion in the fourth quarter. To be clear, this merely implies that the number of people who use Facebook daily has decreased. Both the number of Facebook accounts and the number of monthly active users increased marginally. In addition, the number of users throughout Meta's family of applications increased. However, these figures are sometimes unreliable, so the fact that DAU is down, which has been a critical statistic for Facebook's growth over the years, and the implication that people aren't using Facebook as often as they used to is bad news. Apple's new privacy rules were the third piece of bad news which set the final nail in the coffin. Apple previously assisted Facebook in creating targeted advertising by providing marketers with an identification that allowed them to follow people's behavior on its devices. IDFA has always provided the option to disable it in iOS settings. Apple, however, switched IDFA off by default last year, citing privacy concerns, and compelled apps to ask users if they want to be followed. And it turns out that most individuals don't want to be monitored. However, that has harmed Facebook's ad earnings. In 2022, they predicted it will cost them roughly $10 billion. Because Facebook's ad offering is severely reduced without effective tracking tools, this is the case. When advertisers can target and track people, they are ready to spend a lot more. Both of these things are still possible with other forms of advertisements. When this was taken away from Facebook, their attraction to advertisers fell like a stone, resulting in a $10 billion annual revenue decrease. And things are just going to grow worse in the future. Most Android users will soon be able to opt out of ad monitoring, and Google wants to remove third-party cookies from the Chrome web browser. Okay, that's the most likely cause. Investors were not pleased with Meta's annual results report. Even a poor earnings announcement, however, does not always equate to a 26% decrease. As a result, two background variables are likely to have worsened Meta's stock decline. To begin with, the stock was most likely overpriced to begin with. Take a look at its price-to-earnings ratio, or PE ratio. For example, most corporations have had a price-to-earnings ratio between 10 to 20 in the past. However, Meta's PE ratio was 25 in December. Now we should point out that Facebook was far from unique. Many firms, including their competitors, have historically high PE ratios, but the corporation was, at the very least, overpriced by historical norms. This is perhaps why investors were a little more jittery than normal when the results report was released. After the reduction in Meta's, the PE ratio is presently at 17. The fact that Meta's much-hyped metaverse appears to be pricey thus far surely didn't help matters. The markets reacted well to Zuckerberg's announcement of the metaverse concept in October. They started such a trend that the phrase metaverse came up 449 times in third-quarter earnings calls, indicating that even their competitors were on board with the hype. Unfortunately for Meta, Facebook Reality Labs, which makes the Oculus Quest headset, has already lost $3.3 billion. And while their research and development are beneficial, the rewards of this metaverse game remain at least 10 years away. As a result, investors are becoming concerned about the strategy's risk. Another factor is that investor confidence is already low, and it is expected to be even worse by the end of 2021. The stock market was at its most expensive level ever. The Schiller PE, or price-to-earnings ratio adjusted for inflation, of the whole S&P 500 was at 38%, the highest level in 20 years. In addition, the Buffet Index, which measures the S&P total market value to US GDP, was at an all-time high. You get the idea that by historical standards, the stock market was overpriced. So this, combined with the possibility that inflation-induced interest rates may spike, has made investors nervous, which is at least in part why they reacted so strongly to Meta's disappointing earnings announcement. But what do you make of this situation? Is it concerning that Meta plummeted so dramatically, causing the stock market to take a hit as a result? Is it focusing on the right things with its metaverse drive? Or has the firm been harmed by other companies like Apple and TikTok? Please share your opinions and let us know if you'd want to see more videos like this in the future. That's all we've got for the day. We hope you enjoyed today's video. Also, subscribe to the channel and click the bell icon to be alerted whenever a new video is released. We'll see you at the next one. Until then, peace.